Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of offshore voluntary disclosure tax amnesty. In application, offshore voluntary disclosure and tax amnesty are essentially the same. The idea is to get into compliance for unreported prior year offshore income accounts, assets, and investments. At the end of the day, the main prerogative is for the taxpayer to be in compliance. There are various offshore and domestic disclosure programs, depending on the government organization, whether it's the IRS, different states, different countries. But the purpose of today is going to be just the offshore tax amnesty and how offshore voluntary disclosure tax amnesty can assist taxpayers. So offshore tax amnesty generally occurs in the following type of situations. A U.S. person, whether a citizen, green card holder / legal permanent resident, or foreign national who meets the substantial presence test, has unreported or undisclosed offshore income, either earned income, investment income, even if it's been taxed overseas, even if it would be excluded under the foreign earned income exclusion. There may be undisclosed offshore assets and accounts, bank accounts, savings accounts, investment accounts, real estate property, stock certificates, things like that, life insurance. There may also be undeclared foreign business interests, foreign partnership entities, or foreign trusts. The IRS has various international information reporting forms that individuals, trusts, and estates, small businesses are supposed to file when they have certain interests overseas. Once a person has not filed those forms or paid income, paid tax or reported the income, then they're considered out of compliance. Common examples of how U.S. persons come into these types of offshore income accounts, assets, or investments, they might have inherited the money overseas, and that money never stepped foot in the U.S. So maybe a U.S. person, permanent resident, is here, and maybe his grandma is back in Peru, and she passed away and left $500,000 in an account back there. It's never been in the U.S. That money's never been transferred to the U.S. The income's never been brought to the U.S. It's safe to say that that U.S. person may have no idea that it needs to be reported. There may be family money or business. We have lots of clients who come here as a student, or they just graduated, and maybe the foreign parents gift them some money in the United States, or finally tells them that they're actually like a 10% owner of a family business that the U.S. person didn't know about because his or her parents never discussed it with them, and now they start collecting some income. That income may be taxed or not taxed overseas, and there was just no knowing that while there was a business ownership the whole time, or dividends being issued, even if not transferred to the U.S., there could be a tax and reporting requirement. Another common issue we come across is when a foreign person comes to the U.S., they may have one or several accounts or assets overseas that predated becoming a U.S. person. Now they're a U.S. person. Well, nothing really changed from the offshore holding perspective, but from the U.S. perspective, the moment that the foreign national becomes a U.S. person, well, all those accounts are reportable. It's a common misconception, understandably so, that you only have to report income that's transferred to the U.S. or accounts or assets that you get under your name after you've become a U.S. person. Why would the U.S. care about accounts and assets that you had before you ever stepped foot in the United States? When it comes to foreign mutual funds and other investments, it gets very complicated because of the PFIC rules. PFIC is Passive Foreign Investment Company, and it just incredibly complicates an otherwise simple investment, such as a foreign mutual fund. Countries such as the UK, India, Australia, all the Asian countries, when a person has a mutual fund overseas, it's probably growing tax-free. There's nothing to worry about, no headache. It may be switched out, it may be redeemed and repurchased for no tax. Different capital gains rules, different short-term versus long-term dividend tax rules. In the U.S., the U.S. hates PFICs, and so it becomes super complicated in terms of, are there distributions, are there excess distributions, did it touch an outside bank account, or was the owner issued a check and then immediately reinvested it? Well, that's probably considered a taxable event. In the U.S. or overseas, it may not be. There are various different offshore amnesty programs. There's another misconception that they did away with OVDP, So they've done away with all offshore disclosure. That's not true, not in the slightest. OVDP was a offshoot of the traditional voluntary disclosure program. While OVDP was around between 2019 to 2018, OVDP was used for offshore-related matters. Fast forward to 2019, 2020, and the IRS expanded the traditional voluntary disclosure program to handle both domestic and offshore. There are the streamlined procedures, streamlined domestic offshore procedures, streamlined foreign offshore procedures, both of them for offshore accounts, assets, investments, and income. The domestic and foreign in the title refers to the residence of the taxpayer. There are the delinquency procedures, delinquent international information return submission procedures, delinquent FBAR submission procedures, and of course reasonable cause, which can be used before a penalty is issued or after in order to abate it. Again, my name is Sean Golding with Golding & Golding. We have lots of free resources available on our main website, goldinglawyers.com. We have a sister website, IRS Streamlined Procedures, specifically to help individuals and others navigate the Streamlined program. Thank you very much for your time. Enjoy the rest of your day.